Hi, and welcome to Fixed Income Securities. Today we're going to look into arbitrage free valuation. So let's get to it. So first up is the introduction, where we're going to look at the three different yield curves that we encounter in fixed income. And then we're going to look at the meaning and importance of arbitrage free valuation. And then we're going to make an interest rate tree. We're going to calibrate it so that it gives us the arbitrage free valuation. And then we're going to price a bond using this tree and find that it gives us the correct arbitrage free price. And lastly, and quite short, we're going to look into the Monte Carlo method. So arbitrage free valuation is just that all the parts of finance they have to fit together. So in finance you have these assets, and these assets they create cash flows, and very often you can replicate the cash flow from a set of assets by using another set of assets. And if you have replicated the cash flows between some assets, these assets have to have the same price. Okay? For example, if you want to take a long position in a stock and you have no money, okay? Then you would sell a bond. You would get cash at time 0. You have to repay this at time 1, and then this cash that you get from selling the bond, you buy a stock. So the idea is that you sell a bond and you buy the stock at time 0, and at time 1 you sell the stock and you repay the bond. The stock might go up or it might go down, so you might end up losing on this bet. But the important thing is, in this lecture, how could you replicate this position? And you could replicate it by entering a long futures contract. And when you enter a long futures contract, we disregard the margin account now. If you enter a long futures contract due at time 1, then you pay nothing today. But at time 1, you get you have to buy the stock for a certain price. Okay? Which means that you put up no money today and you get a certain value based on the value of the stock at time 1. Which means that these two portfolios, the portfolio with a sold bond and a long stock, should be equal to the price, the future price of the long futures. Okay, so this is what we are going to do in the bond market in this lecture. So here we go to the yield curve, a bit of a refresher. And what does the yield curve actually tell you? It tells you the time value of money. And we have 3 kinds of yield curves, okay? So the major ones are par yield curve, the spot yield curve, and the forward yield curve. So if we start with the par yield curve, then we see that the par yield curve is the coupon rate, which makes the price of the bond equal to par. It's usual to set par equal to 100 in these cases. So what do we have here? We have the assumption that the price of the bond should be set to 0, or to 100, I mean, and we have the future value of the bond, which you have to repay. And if you are given the spot rates from the spot yield curve, then the only unknown in this equation would be the coupon rate, the payment. Okay, so in this case, you would not get an analytical answer. What you have to do is find this coupon rate numerically, and numerically just means guessing. Guessing in a fairly systematic way. Okay, so you have to guess the payment. If the payment you put in is too high, then the value of the bond is higher than 100. Then you have to lower the payment. Okay, so that's how you find the par yield curve by using the spot rates. Okay. You also have the spot yield curve, and often you would find this spot yield curve, which is the discount rate for payment at one specific time in the future. Okay, so for example, we have the 1 year spot rate, we have the 2 year spot rate, and the 3 year spot rate. Okay, and how do you find those? Well, you look at the zero coupon bonds in the market, hence the Z. The price of the zero coupon bonds in the market should be equal to the future value of the zero coupon bond divided by the discount factor. Okay, so what do you have here? You have the market price, you have the future value, and what you don't, and you have the time to maturity. What you don't have is the spot rate. And here you can actually get an analytical answer. So you just use algebra to find an expression for ZT. Okay. So that's how you find the spot yield curve. Okay. So what if you need the forward yield curve? What is it? It's also a discount rate, but this discount rate starts in the future and ends in the future. Okay, that's why it's called an implied future rate. Okay, and how do we find this implied future rate? So the year 0 into 1 year implied future rate is really just the same discount rate you use for the 1 year spot rate. Okay, you see that they are covering the same time frame. However, the 1 year into 1 year implied future rate, it covers the distance between the 1 year and the 2-year spot rates. So how do we find the implied future rate? You take the difference between the 2-year spot rate and the 1-year spot rate, and you calculate the geometric difference, which means that you take the 2-year spot rate divided by the 1-year spot rate and subtract 1. Then you get the implied future rate, 1 year into 1 year implied future rate. And you can do the same for the other future rate, the 2-year into 1 year future rate. There you take the 3-year spot rate divided by the 2-year spot rate and subtract 1. Okay, so if you are given one yield curve, then you can easily find the other yield curves. For example, if you have the par curve, then you can easily find the spot rates or the forward rates. Or if you have either one of the other rates, you can find the 2 other rates. Okay? So, but what's important is how do you use and when do you use these curves? For example, the par curve is often used when you issue new bonds. And why is that? For example, when you issue a new bond, let's say you want to borrow 100 million euros, okay? You want to sell a bond with a face value or a future value or a par value, these are synonyms, of 100 million euros. You want to be quite certain that when you sell the bond, you get 100 million euros, and because that's your needed cash. Okay, so what you do is that you find the maturity of your bond, and you find the par rate of your bond, and this is actually the coupon rate you have to put on your bond for this bond to be sold at par value. So if you have this coupon rate, you're quite certain that you would be able to sell the bond for par value. So you know what kind of cash you get into your company. Okay? And the spot rates are quite useful to discount or to get the present value or the price of future cash flows. So for example, if you have a cash flow coming in 5 years, then you can easily find the present value of this cash flow, the price of the cash flow, by using this 1.819% discount rate. Okay? And you can also use the forward rates to find the present value of a cash flow. That's no problem. You just have to geometrically combine them, like that would be 1 plus this discount rate times 1 plus this discount rate would give you the discount factor for a cash flow occurring in 2 years. But the main use of the forward rates in this course, and especially in this lecture, is to create a tree, an interest rate tree of forward rates. Okay, so we are going to create a tree where the forward rates can differ. Now we get to the law of one price. This means that if two assets with the same cash flow, they have to have the same price. Otherwise, you would buy the cheap one and sell the expensive one. And there are two kinds of arbitrage opportunities, and one is the value additivity, which means that you can decompose the cash flows from an asset, and the value of the decomposed cash flows, the single cash flows, they really have to add up to the value of the combined asset. The other kind of arbitrage opportunity is the dominance. Here, if you can make an asset by combining other assets, so that you have no cash outlay today, and you have a positive cash flow with certainty in the future, then you have an arbitrage opportunity. Because if you have a positive certain cash flow in the future, you would have to discount that cash flow to find the price today, and that price would be positive. Thinking about arbitrage free valuation, in the bond market, we have a very important relationship between coupon bonds and zero coupon bonds. What you can do is that you can strip a coupon bond, which means that you are buying US Treasury, for example, a coupon bond, and then you're selling zero coupon bonds corresponding to the cash flows of the coupon bond. So what you are doing is that you buy the coupon bond and you're selling zero coupon bonds. In effect, you have been stripping the coupon bond, and hopefully you will make a profit doing this. What you can do is to reconstruct a bond by using zero coupon bonds. So if you have a series of zero coupon bonds, you're long in zero coupon bonds, you can actually sell a coupon bond. And this means that the market will balance, so that the zero coupon bonds price, combined price, will be exactly equal to the price of the coupon bond. If you have an option-free bond and you want to find the arbitrage-free value of that bond, then you would just take the present value of the cash flows of that bond and combine them into the price of the bond. And here you would use the benchmark spot rates if your bond is a risk-free bond, which means that it does not contain credit risk. And the benchmark spot rates you would get from the prices of benchmark securities. Benchmark securities are often considered risk-free, and they are often government bonds, like US Treasuries. And you see here that you just use the benchmark spot rates to discount every payment or cash flow from the bond, and you combine them into the price of the bond. And this price is actually the arbitrage free value of your bond. So here is an example how to get the arbitrage free valuation of a bond. So this is a 4-year bond, and you have the spot rates and the forward rates. Okay, so it's a 4-year bond. It's a 6.5% coupon. So if you use the spot rates, which you find here, then you discount the cash flows with the corresponding spot rate raised to the corresponding power, and this will give you the arbitrage-free value of the bond. If you use the forward rates, then you would discount the corresponding cash flow with the corresponding forward rate, and you would get the same price because the spot rates and the forward rates, they have to match up. So you get the same price of these valuations. Sometimes your bond has an option attached to it. This can be a put option, which means that the owner of the bond can sell the bond back to the issuer for a specific price. Or it can be a call option, which means that the seller of the bond have the option to buy the bond back at a certain time for a certain price. And we know that the bond price, it varies with the interest rate level. So with the interest rate risk in the market, you might end up in an interest rate range where the option is exercised. This means that we have to create an interest rate tree to actually be able to calculate the bond price with the option attached. So, and the interest rate tree, it gives us two things. It may give us the information about what kind of cash flow the bond will pay. For example, if you have a bond with a floating rate, like a floating rate note, then the interest rate will or the coupon will be dependent on the interest rate. And secondly, the interest rate tree, it will supply us with the interest rates to discount the cash flows. And what we need is a way to define the possible values of the interest rate process. And for this, we use the binomial interest rate tree, which means that the interest rate can, from each node, go either up or down. Only two options. And in order to create this binomial tree, we use the benchmark interest rates. And we use these benchmark interest rates to get the arbitrage-free prices of ordinary bonds. And these prices we use to calibrate our interest rate tree, so we know it works. In addition, we need to define what kind of relation the different nodes in our interest rate tree has. So we need an interest rate model. And to create this tree, we also need to know how far apart nodes are going to be. So we need to assume an interest rate volatility. From the binomial model of interest rates, we know that there will be two possible values for the 1 year into 1 year implied forward rate. Forward rates are often called short rates as well. So what we need is an interest rate model, and in fact we assume the model to be log normal because it's giving us non-negative interest rates. And this log normal model is also often used for any kind of non-negative price process, for example, stock prices. And the log normal relation means that the down move is linked to the up move by 2 standard deviations. This is the e to the power of 2 sigma. And that's because in the binomial model, the interest rate goes either down by 1 standard deviation, or it goes up by 1 standard deviation. So the difference between the high node and the low node would be 2 standard deviations. And what is the standard deviation? It's the interest rate volatility. And we have a different video explaining how you might estimate the standard deviation. Here you have how the interest rate tree actually looks. So you have at time 0 only one interest rate. It's the 0 year into 1 year interest rate, which is the interest rate which you would discount the cash flow you get at time 1. So this I0 is the interest rate you use between time 0 and time 1. And the interest rate I1 is the interest rate you use for cash flows occurring at time between time 1 and time 2, often coming in at time 2. Okay, so if you have cash flow at time 1, you use the I0 interest rate. If you have a cash flow at time 2, you use the time 1 interest rate to get the present value at time 1. And then you can further use the interest rate at time 0 to discount the present value at time 1 into the present value at time 0. And here you can see that as you move on in time, you get more and more combinations. So the interest rate can go from the current state and go either up or down. At every node, these are the nodes, it can go up or down to the next node. And that's why you can make the interest rate process contain many different kinds of interest rates. And here you get the interest rate tree using our log normal interest rate model. So you have the I0, the interest rate, the forward rate at time 0 for 1 year ahead, and in time 1, this interest rate can either go down by 1 standard deviation, or it can go up by 1 standard deviation. And the relation between these two would be a difference of 2 standard deviations. And by just using this method, you can create the whole interest rate tree. So a key factor in our interest rate tree is the volatility, the standard deviation. And there are 2 methods which are used, and one is to use the historical interest rate, and we have a video on that. And the second one is to use the implied volatility. And with the implied volatility, you use an option price in the market, and you plug everything into an option price model, and you see what kind of volatility the market price of the option actually corresponds to. And often the option markets, they already price their options based on volatility. So it's quite easy to get the market implied volatility from option prices. How do you determine the value of a bond at any node? Well, then you have to work backwards in time. So remember, when you create the tree and when you calibrate the tree, you work forward in time. You start at time 0, then time 1, and then time 2, and so on until maturity. And when you value the bond, you start at the end, okay? So you go backwards. It's called backward induction valuation. So what you do is that you take the known values from, for example, time t plus 1, and then you have face value and you have a coupon, and this cash flow, it's discounted using the discount rate at time t. And what we usually surmise is that an up move is equally probable as a down move. So these 2 moves have a probability of half. And then you can just take the probability valued or probability weighted value of the 2 states, the up move and the down move, and find the bond value at time t. And we can look at an example, and we saw that the probability is half for an up move, and the probability of a down move must then be half. And you use the forward rate at time t, and you use the cash flow or the bond value at time t plus 1. So then you can find the value at any node. Now we have all the tools in the trunk that we need to calibrate the binomial interest rate tree. So what you do is that if you have a par value yield curve, then you find the spot and or future rates. And for these future rates, you have to define what kind of volatility this interest rate process is going to inhibit. Okay. So what you do then is that you calculate, or you have zero coupon bonds for each maturity of your interest rate tree. So you can use these zero coupon bond prices to calibrate the tree such that the tree returns the market value of the zero coupon bond given the payoff, the cash flow of the zero coupon bond. And that means that you have to start with the shortest zero coupon bonds and just work your way step by step upwards until you have the longest maturity cash flow correctly valued by the interest rate tree. And once you have done this, the interest rate tree is arbitrage free. There will be a separate video showing this in Excel. But we can go through the recipe here. So here is what you know, okay? You know the price of a 2-year bond, let's say. This interest rate tree is just like a 2-year tree, okay? So the interest rate can go up or it can go down. But the principle is just transferable to other periods, okay? So what you do know is the 1-year spot rate, because the par rate and the spot rate and the implied forward rate for 1 year, they are equal, okay? And you know this at time 0. So what you estimate is the volatility. And you have 2 kinds of major approaches. You can use historical interest rates, or you can use implied volatilities from the option markets, okay? And there's a separate video on that. And you use the relation that the up move is equal to the down move scaled by e to the 2 sigma power, okay? And this holds for any node, that the high part of the node is equal to the low node times a scaling factor, okay? Which means that you can assume in the log normal model in our framework that the probability of an up move is 0.5 and the probability of a down move is 5, okay, 0.5, sorry. And what you do then is that you take the payment in the up move and you discount it by the up move interest rate, okay, to find the present value of this payment at time 1. Remember, we have a 2-year bond, so this payment, it arrives in 2 years. So this discounting creates the present value at t equals 1, okay? And you also take the probability weighted present value at time 1 of the payment for a down move, okay? So in order to get the present value at time 0, you have to scale it, or you have to discount it, I mean, with the already known interest rate, 1-year interest rate, okay? But here we have 2 unknowns, okay? Everything else is known. What you do is you use the relation that the high move is just a scaled down move, so you insert that here, okay? Then you only have 1 unknown, and you can change this unknown. You can guess systematically the value of this unknown interest rate such that the present value of your bond matches the present value or the price of the bond in the market. Okay? And this is why it's quite beneficial to use zero coupon bonds, because then you only have payment, one certain payment at one time in the future. Okay? So that's how you calibrate the tree. To check your tree, and you always have to check your tree such that you are certain that it's arbitrage free. You first calculate the arbitrage free value of a vanilla bond, like a straight coupon bond, and you use the yields that you have calculated from prices in the market, like spot rates or forward rates. What you do then is to calculate the same bond, the value of the same bond, using your binomial interest rate tree. Okay, so if these prices are equal, then your tree works. Then your tree is arbitrage free. To see how this works, we can go through an example. Okay, so we have an ordinary bond with 3 years to maturity, and it pays 5% coupon. Okay, the coupon rate is 5%. So we have a series of spot rates, and the first year spot rate is 2%. The second 2-year spot rate is 3.015%, and the 3-year spot rate is 4.055%. And you already know how to use this, the spot rates, to calculate the present value of the bond, or the present value of the cash flows. And you get to a cash flow or present value of the cash flow of 102.81. Okay, so let's see how we can do this with our tree. Here we have already calibrated our tree using the method of 2 slides ago, and we have assumed a standard deviation per year of 0.15. 15%, and we start off by the 1-year interest rate, which is 2%, and then we have a down move or an up move at time 1, and beware that the time zero interest rate is what you would use to discount a time 1 cash flow. Okay, and a time 1 interest rate is what you would use to discount a time 2 cash flow to give the present value at time 1. Okay, and you see here that you have a binomial tree, so if you go up and then down, it's the same as going down and then up. And if that's the case, we call it a recombining tree. Okay, so these are the interest rates we are going to use to value our bond with a tree. So here we have the values at the nodes, and what we do is that we start at the end of the tree. Okay, and why do we do that? Well, that's because this is a 3-year bond. And the present value we know is the cash flow at time 3. We know the cash flow is the face value plus a coupon. So this is the value, or the cash flow at time 3. This is the interest rate, the implied forward rate at time 2, given two high moves, two up moves of the interest rate. Okay? So what we do is that we take the probability weighted present value of the time 3 cash flow to get the time 2 present value. Okay? And we have to do this for the up move and the down move. Okay? And the present value is 9707 for this particular node. Okay? And what we do is that we can see here, if we have the whole tree, now we started over here. Okay? The interest rate went up, or the first interest rate is 2%, then it went up. Here it's 4.6%, then it went up again to 8.167%. And we took the time 3 cash flow and discounted until time 2, okay, to get the time 2 present value. So you see the up move and down move here gives the same present value. Okay, so our value here is $97.07 dollars, and this is what you would sell the 1-year bond, because here the bond has 1 year until maturity. This is what you would sell the bond for if you had 2 up moves until time 2. Okay? So if we go back, we can see that you do exactly the same for an up move and a down move, or a down move and an up move. You take the time 3 cash flow and you take the time 2 interest rate from a down move and an up move, and you take the probability weighted value of this, and we get to a value of 99. And likewise, we calculate the same node after 2 down moves in the interest rate, and we get the value of 100.49. Okay? So what we can do is that we calculate now the time 1 present values, and at time 1 the nodes at time 2 values are used. This is the value of the 1-year bond, but at time 2 you also get the coupon. Remember that. You have the value of the bond and you have the coupon. And you take the discounted value of this to get the time 1 present value after 1 up move in the interest rate. And this is 98.46. Let's see where we can find this. It's here. Okay, so the value of the 2-year bond, because the bond has 1, 2 years until maturity, giving a 5 coupon here, 5 coupon here, and 105 cash flow here. The value of this is 98.46. At time 1, you also get the coupon of 5. So remember that, okay? Because, sorry, we do this for the down move as well to get the present value of the bond, the remaining of the bond at time 1. And at time 0, you use the present value at time 1 plus the coupon at time 1 to get the present value of the bond at time 0. And we see that our tree is correctly calibrated because we see the present value here is 102, and this corresponds to the value we got, the arbitrage free value we got from the spot rates. We have seen that the interest rate tree, it contains a lot of paths, and you can think of the number of paths as the combinations of up and down moves, high and low rates, and if you specify or you just list all of the potential paths through the tree, and these paths are all equally likely, then you can determine the present value of a bond along each path, and just take the average value, average present value of these paths, and that would be the present value of the bond. For example, we have the same bond, the 3-year bond, and we can see that in our interest rate tree there are 4 different paths, which are the up move and up move, okay, or it's the up move and down move, or it's the down move and up move, or it's the down move and down move. So there are 4 different present values to be calculated, and that would give us the present value of the bond. If we use the implied forward rates from the tree and the different combinations along the paths, then we can calculate the present value of the bond along each path. And here you take the average of the present values, and you see that we get the same result as previously, 102.81. What do you do if your asset is path dependent, but the number of paths are not countable? And you remember that in our interest rate tree, you only have an up move or a down move, so it's binary. This means that it's quite easy to find the combinations of up moves and down moves, and find all the paths. However, if your interest rate what do you do if your asset, the price of your asset is path dependent, but you're not able to count the possible paths. Okay, so remember that in our interest rate tree, we have two possible outcomes. We have an up move or a down move. Okay, what if instead of this binary choice, we have a continuous choice? For example, that we draw from a normal distribution to see where the interest rate is going from one period to the next. So if you have this continuous case, then you have to use the Monte Carlo method to price your assets, and you just draw sufficiently many interest rate paths, for example 10,000 of them, and then you calculate the price of the bond for each path, and then you assume that all of these paths, they are equally probable. So you just take the average of the present values you found, and that would be the value of the asset given the Monte Carlo pricing method.